Welcome to Futures Friday. Hope everybody's doing great. Ready to kick off a nice little weekend. You know, I'm not as you guys know, I'm not a fundamental analysis type of guy. But one thing I thought was really interesting, it's always kind of cool to share these, what kind of things are going on with different industries or whatnot, I recently bought a truck and I had to drive out of state to get it. And, here in Nashville, it's impossible to get them. And in fact, the ones that they have coming, they're sold at sticker before they arrive at the lot. So, for example, one dealership had 12 of them coming, all sold before they even arrive. No discounts. I thought that was interesting. As you guys know, I do triathlons and cycle and things like that. I was at the bike shop yesterday, and they are selling as many bikes. This is a long-standing shop. They're selling as many bikes per month recently as they have in the past per year. So it's just really interesting. And, I have no idea whether that is due to some of the stimulus, and the checks, or whether that is more. Obviously, it's a tiny snapshot, right? I mean, I'm not saying that it's massive implications. Take it for what it's worth. But I just found both of those things kind of interesting about well, how are these businesses doing? But okie doke. Yeah, obviously, like I didn't say, as Bryce says in the chat, yesterday I was talking to my local movie theater owner, and that would be a very, very different conversation. That's a good point. So obviously just a snapshot, so take it for what it's worth. Okay. I see the questions starting to pile up here. So let's dive into it. Just for anyone new here, the format is to click the Q&A box. First come, first serve basis. I look at the Q&A box for the questions that I will take. This is mentoring for you guys. So bring your questions or scenarios or trade sequences or whatever you like, and we'll talk about it. The chat, if you're going to chat, change the to field from all panelists to all panelists and attendees, and use that for just general banter, perhaps as any kind of follow-up or commentary on what we're discussing. But I will be looking for questions on the Q&A box. So Tom says, hi, Merritt. I have 2 questions regarding risk. What are your thoughts on risk per trade in dollar value for someone on tryout? What would be the best R for trades taking into consideration daily loss limit? Great question. Let's go ahead and read this second one as well. Number 2, I have trouble going up from one lot trading, feel comfortable. Okay, so let's table that. They're not too related. Okay. I think this is great, Tom, that not that I'm so great, but who better to ask than the designer of the trial? Well, hey, what do you think about risk, and what would your approach be? So kudos to you for looking for some good advice on this stuff. So in general, let's talk in general first. In general, I think the best way to approach risk is obviously some type of, I'm going to draw here on the screen I'm sharing. Something financial, right? I mean, that, and again, I'm going to give a very broad view, and then we're really going to narrow down first. So we're going to help you, and we're going to help a bunch of people. First, you start with some financial thing, right? So it's, I don't know, your portfolio size, whatever it is, tryout risk limitations, risk of ruin with max drawdown, like in a tryout, whatever it may be. And from there, you need to figure out for you what kind of daily loss limit makes sense. And by the way, those of you in the tryout, and this may take a step further with what you're asking, Tom, just because we set a grand daily loss limit does not mean that that needs to be your daily loss limit. That's just us putting something out there that is, look, you should definitely not, we don't want to see you. We want to see you with such a trading method that you do not draw down more than 1,000 intraday. That's just something we have chosen as a firm to do for brand new traders who have barely shown us anything on maybe 15 measly days of trading, right? So let's go back to general topic here. Starts with overall financial picture, and then you need to figure out from there a daily loss limit. From there, I think it's really important to go into number of opportunities and or necessary attempts at opportunities, however you want to look at that. I think it's really important for your methodology, for your style of your trading. How many trades do you need to be able to take per day? I think for a lot of people, that 3 to 5 per day is probably a really nice sweet spot. Some people need more. Some people can handle less. It's time frame dependent. It's strategy and methodology dependent. So, but you need to consider that, because once we have daily loss limit and the number of opportunities we need, we can essentially back into or take this approach in finding out our what we call dollar R value, which is essentially your max risk per trade, right? And that's just a really good way to approach figuring that out. And so it's pretty straightforward from there. Now if it was $1,000 daily loss limit and you only need 3 max attempts per day, well, you just divide the two, right? So you've got your $333 of, theoretically, right? You wouldn't want to cut it that close, but because it's a rule where you fail out of our tryout if you do that. So you wouldn't want to cut it that close. You need to factor in commissions, blah, 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 blah. But, just back of the napkin here, that's what that would look like. But that's the general approach that I would suggest to kind of come up with your question. What would be the best R value? Here's the thing that's been a real game changer, and I think needs to be a pretty, I tend to speak quite frankly, and quite frankly, I think everyone in the tryout should be on micros. Maybe we should change the rules. And I know micros aren't available for everything, right? Maybe we should change the rules. If you're trading US equity indices, the only thing you can trade is micros. I kind of feel that way. I really do. Because you shouldn't, spoiler alert, you shouldn't be risking $333 a trade in the tryout, in my opinion. Your risk of ruin is too high, right? You're talking about essentially around 1/10 of your risk of ruin per trade, and that's fairly tight, right? Not to mention, the main thing that's going to happen is it's going to conflict with the number of opportunities per day. That's what's going to happen. You're going to, if you really need to get to that 5 attempts per day or something like that, well, if you're risking $300-400, and by the way, if you get some slippage or have a whatever happen and you lose 500, it's easily doable if you're trading, you know, 2 or 3 lots of a standard product with decent volatility or whatever, and on the full size contracts. Well, guess what? Boom, half your day's gone. You know, that type deal. So a sixth of your, 18% of your max drawdown gone, that type stuff. So very important to reduce risk. Screw 15 days in the tryout, guys. I highly suggest that and again, maybe we need to change some of our language on that tryout and whatnot. Our goal is not to entice people that you can become a millionaire after 15 days and blah. I think if people get that that's not SMB's shtick or culture. 15 days is, I don't know. It's just the bare bones absolute minimum for us to even remotely consider you as a talented trader. That's all it is. How should you really approach? You should reduce the risk. You should have a, $500-600 daily limit, maybe less. Trade the micros and plan on being in that tryout for 3 months. That's my advice. Because guess what? That's how I'd like you to operate on the junior desk. Nobody is on our junior desk who has come out and they're just swinging 6 contracts of crude. Nobody's on the desk that has ever done that. And there's a reason for that, right? The risk doesn't make sense. It's too risky for your job and your job description and your limitations. All right. Second question. I have trouble going up from one lot trading. I feel comfortable with one lot, but at the same time, I see that I could manage my trades more efficiently, scaling out of trades before reaching the main target. I wonder if you have some advice on how to take that one step further. Do you think that scaling out messes up initial risk reward for each trade? Okay. This is a really good question. There's heated debate out there regarding, some answers and whatnot. And I've had conversations with pros. I've had conversations with veterans. I've had conversations with a ton of people regarding this. So I think I have some pretty good answers for this for you. At the end of the day, when you introduce scaling, all in, scale out, what you're essentially doing is you have something of a portfolio of trading systems, and then you have a short-term system and a long-term system. They just so happen to share the same entry. And if we were to look at your equity curve, you could track this differently than this. You could treat them as separate trades, even though they were overlapping in terms of the hold times. And you would typically see the short term with lower risk reward and higher win percent, right? That's just the way things work. Easier targets, closer targets are going to be hit more often, and you're not getting the same risk multiples. That's just the science of the math of the charts and trading, whatever. Sound like an idiot. Okay. Long term, longer targets holding for bigger moves. Obviously, risk reward goes up and win percent goes down. And you can model any generic trading systems. Let's say that this one has a 60% win percent and 1-to-1 or something. Let's say this has, 3-to-1 and 42%. Well, plug them in, run a randomizer. You know what I mean? Like, boom, you're going to see that your one's going to be a little more slow and steady with minor drawdowns, and one's going to kind of, be a bit more drawdowns, and kind of get some bigger gains along the way. How this precise numbers you use for these things is going to affect, whether it's like this and the others like this, it depends. Depends on the edge. But that's the general nature of those things. So with that said, I think it's important that so the second part of your second question here was, do you think that scaling out messes up the initial risk reward for each trade? That's from a line of thinking that it's the same thing, and you get long here and you scale out of one here and you scale out of your second one here. And so obviously if your stop was here and your entry was here, well, you're making, let's just bear with me, it's not to scale here, 1-to-1 on your first position and 3-to-1 on your second position. So if you had just gone all in, all out, what would you make? 3-to-1, 3 full big boy R's. But with your new method, what do you make? You make 1 on half, and you make 3 on the other half. What do you really net? Is it 4? Did you make 4? No. What did you make per contract is what matters. So we traded 2 contracts. So you reduced your gain by a full R for the same amount of risk, right? But what people don't take into consideration, and they often glaze over and forget, is that at point 1 here, they proportionally reduced their exposure. You reduced risk. So there is no free lunch in trading, but just for someone to come in and say, well, you only make 2R, you would have made 3R. That's not a valid argument, because you reduce the upside because you reduced your downside when you scaled. You booked some profits and reduced remaining exposure. So it's not a negative, okay? The way I see it as a pro trader with no salary is that I prefer, even if I do reduce my overall expectancy by a bit, my portfolio, including scale outs, as I mentioned, right, the portfolio model, it's going to essentially smooth out my equity curve rather than having as drastic of drawdowns. Typically, drawdowns are my fault, not as much the methods. What else can we say about this? Because it's a really important topic. And I am going to address your question as well from a mental perspective as well. Along the age-old argument with this type of stuff, final point here. What truly matters, what is ideal and highest efficiency and most expectancy for you, is going to depend on how often, essentially, the various win rates of various sequences. How often do you get full target, right? That's the longer target, right? Versus how often do you get scale, which is that first initial target, right? Let's just do T2, right? Scale at T1, and then stopped. How often do you simply get stopped, no targets? The win percent of each of those events is going to truly, at the end of the day, determine, as you get bigger and bigger from 2 lots to 10 lots, how much you should scale for a particular opportunity given its stats along these lines, how much you should leave on for a core position, should you scale, those type of things. But remember, as a professional, as a livelihood, as a human, as someone who has, cash flow, stuff and whatever, uh, and emotional stability, and you name it. Um, Drawdowns suck, and it's not necessarily for me entirely about squeezing every last bit of positive expectancy out. It is a little bit of where's your risk tolerance and what do you want in terms of returns and drawdown. There's choices to be made there that don't necessarily line up with what is absolutely ideal on the back tester, right? So that's my full kind of, I think, I'm sure there's more I could cover, but that's kind of the initial laying the groundwork here for that topic. So now let's address the mental side of things. You're having trouble scaling up from one lot. You feel comfortable with one lot. You see that you could, perhaps improve, do some things better if you scaled, which obviously means trading more than one lot. So actually, maybe I misread your question the first time. It doesn't really seem like you're, at first I thought you were struggling with trading bigger, but I guess you're actually not. You're just debating whether or not you should do that. So I guess that's a complete answer. So let's move on. Hey Merritt, a couple years ago during an interview with Gradelli, you spoke in depth about execution. I was wondering if you still take an all-in scale-out approach, or has it been modified since? It is mostly all-in scale-out to this day. I will break up orders just for liquidity sake, depending on the situation and stuff like that. So if in a perfect world I could just click the buttons and trade a 10 lot or something, then absolutely my methodology is still all in scale out. Yes. Hi, about using DVA on the intraday chart. When is it better to use ETH and RTH? As a standard, I use ETH if the overnight wasn't too volatile. Comparing it with RTH today, I see it could have had better reference for entries on the RTH. There's no answer to that really at the end of the day. I think it's a good best practice when you'll lean on RTH a bit more if the overnight session was pretty volatile. The ultimate answer is to either just be comfortable using one, because guess what? We never know where which day the ETH is going to give, with the benefit of hindsight, the best trades, and which day the RTH is going to give a hindsight with best trades. There's not a lot of method to that madness. So the ultimate answer is one of two things. One, just pick one and just use it. Right? Two, I'm going to give you three answers. Two would be learn to use them both. Learn to not give yourself too many potential entries all over the place, because you're doubling your potential entries a lot of times early in the session using both. So learn how to do that effectively. And thirdly, maybe move away from fixed time based DVAs and play around with some anchored VWAPs or things like that, and customize it to what you're seeing and where the conditions shift and where you want to begin to monitor that particular sequence. So a couple different things you can do. I don't think that any one of them are going to give you something, tremendous over the other. They're all good. They all work. They all don't work. It's that age old thing. Everything works. Nothing works. Hopefully that helps. Hey, Merritt, is there a list of qualifying triggers you want to see before entering or exiting a trade? For instance, narrative is confirmed, levels defined, risk reward in your favor. Um, I don't think I can answer that on this webinar. I mean, my students know exactly what my process is for getting into trades. It's very in depth. It starts before the market opens. It's just not something I could cover in detail on this webinar. But absolutely. So what I can tell you is I need to see a minimum risk reward. It needs to make sense with narrative, like you said, being confirmed. I use other short-term checks like rhythm, acceptance, all these kind of things that make up the full methodology that need to check off with all these other discretionary, nuanced exceptions that we make depending on context and depending on the speed of the tape and depending on order flow and what's going on, depending on the type of play I'm getting into. They don't all have the same checklist. Some are very narrative driven, and we're going to flip flop the hierarchy of what's important in terms of references for those trades or tools. Some is more of a scalp. I can ignore other things and need other things that the narrative driven play didn't. So it's complex. Edward, how do you manage your overnight trades? Okay. First of all, a lot of people would be surprised to hear that I think of all trades for the most part as just being on a continuous, I don't know, continuum, right? I mean, it's just the trades are either there or they're not. I could really care less if it's 4 a.m. or 4 p.m. or, whatever. So I really don't. Obviously, there are different nature of short-term movement and liquidity based on time of day. Obviously, okay. There's a seasonality to volume patterns, blah, blah, blah. I'm not talking about that. I'm talking about narrative sets up, intraday sets up, don't care what time it is, right? Order flow confirms, blah, blah, blah. Take the trades. Obviously, I don't sit around all night and look for trades. Sometimes if conditions warrant it, like what we saw with the oil markets earlier this year, like what we have seen with some of the volatility with COVID, blah, blah, blah. Yeah, I felt like I was kind of trading around the clock there for a while, but that's just opportunistic. So sometimes I'll adjust my chart. If it's like 9, 10, 11 o'clock at night and volatility is not through the roof, I might go to a time-based chart, which will actually show me more information than my volume-based bars normally do, just to check it out. I will set alerts, which through Sierra Chart go to a special email address that I created only for using it for this purpose. And I have my phone, I have a Google phone. I'm not sure if iPhones can do it or whatnot, but I have, I put my phone in do not disturb mode, I like it when I go to sleep or, whatever. So it's not lighting up. It's not showing any notifications even on the screen or making any sounds or anything. The only thing that will wake up my phone and alert me during those times are, one, if someone in my contacts list calls, doesn't get me, and immediately calls back, within a couple minutes, that second attempt will come through. Obviously, something's important if someone's trying to do that. And two, this email, I let it filter through. I let it come through. So the only reason I use it is I know it's going to wake me up. So I know I want to be woken up if something, were to get triggered there. So I will use that at times, not always, but at times for overnight stuff. And I'm going to have some form of a stop in, right? A lot of times I'll manage my intraday stuff without having stops or just some emergency stops here or there or something. But a lot of times it's very just, I'm on the hotkeys. I'm reacting within milliseconds to anything, including news, you name it. Can I get burned more that way? Yeah, it can happen. Sure. But anyways, it's a choice right now. Overnight. So yeah, I'm going to have the hard stops in. Um, targets I set, it's important that you guys understand how to use multiple OCO brackets so that as targets are filled, your stops are reduced in terms of quantity proportionally. That way you don't end up reversing your position or something that, like something crazy. Then you don't have any stops in and that type of stuff. So using GTC OCOs, right? By the way, if you guys set up some normal, day expiry type OCOs, well, then they're going to be canceled after the exchange reset. They're gone. So don't go on a fishing trip and leave those in. Make sure that they're GTC, good till canceled. I don't know what else, man. I don't differentiate tremendously. And a lot of what I'm saying would apply to, doesn't matter if it's day or night. If I'm away from the desk is the type of stuff that I'm talking about here. Brent, is there a good way to enter fast trends like ES on Wednesday or today that aligns with our methodology when the primary optimal entry point from the edges has already occurred? I would suggest you go maybe, I have a hard time remembering exactly is what in Futures Foundation and what's not, sometimes. So, I know that on my long time, apologies, to-do list is to add a section in Futures Foundation on advanced return pullbacks. So I can't remember if fast trend, maybe some of you, a lot of students in here could let me know if fast trends are in Futures Foundation or not. I can't remember. We should get it in there. So, okay, Toby, I will take Toby's word over any of the rest of you. By the way, Toby is our local photographic memory in-house guru. Okay, so I'll tell you what, Brent and Toby and everyone, you know what? We should act like we hate Toby like The Office. That's what we should do. Every time I talk about Toby, I should be like, gosh, Toby, just shut up. Okay. Let's set up a session next week. I'll let you know the time, the place. We'll set up a special Zoom. We'll record it and we will add it to the foundation material. So give me some time to really think through how I want to teach that. And we will do that next week. Let me jot that down on my notebook here. Below my CB radio gear. Impromptu session on fast trends and advanced return pullbacks. We'll set it up. That's going to be student only. It's foundation stuff, guys. That's going to be students only. Sorry. Okay, let's do one more question, something that I can answer because I was going to do that one. Jiao says, hey, Merritt, I was watching the Futures Friday video of a couple of weeks ago when you made a scalp exhibition. In that video, you shifted to a very short time frame. If I'm not wrong, it was 15 seconds. When looking at bigger rotations, as you mentioned in a couple of these videos, do you use this very short time frame as a filter to get good momentum? No, I don't. The reason I fully abandoned what I normally do was just so that we could get more reps in for that exhibition. That was the only reason I did that. Have I at times in my history, throughout multiple times of trading, experimented with 15-second charts, 2-tick range bar charts on crude oil? You betcha. I've gone through periods where that was a part of what I did. It mostly wasn't worth it for me. That extra good timing comes with the downside of more false positives. Or is it false negatives? It's false positives. Yeah. More, head fakes, right? Because it's a lower time frame. So, keeping it simple on kind of an ideal time frame that matches up with what I'm trying to do, it gives me that right balance, I think, between false positives, right, and valid signals, and the give up in terms of enhanced risk reward that otherwise would be given to me if I were to use a 5-second chart, right? I'm going to be getting in 3 ticks from the turning point instead of 10. So yeah, that was just for the exhibition. All right, sorry guys, we were unable to get all the questions in today. We will I'll try to remember some names here of folks that had some stuff in and post them next week, and we'll get to it. Have a great weekend, everybody. You too, Bryce. See you, Guilherme. See you guys. Cheers. Except for you, Toby.